Wealth isn't just built by what you earn. It's preserved by the mistakes you avoid. Let's identify and eliminate the big ones. Most people believe financial success comes from finding the next hot stock or getting a big raise. But the truth revealed by studies from the National Bureau of Economic Research shows that wealth leakage through small, consistent mistakes erodes more fortunes than market crashes ever do. Mistake 10. Paying for brand name over-the-counter medications and generic groceries. The FDA requires generic medications to have identical active ingredients, dosage, and safety profiles as their brand name counterparts. A 2023 Consumer Reports analysis found Americans waste over $15 billion annually on branded OTC drugs when generics cost 30 to 80% less. The same principle applies to store brand groceries at major retailers. Identical quality, dramatically lower prices. Mistake 9. Carrying a balance on a low rewards credit card instead of a strategic balance transfer. Here's a mathematical reality. Credit card interest compounds against you. If you carry a $5,000 balance at 24% APR while earning 1% cash back, you're paying $1,200 annually in interest to earn $50 in rewards. A net loss of $1,150. Balance transfer cards with 0% introductory APR periods let you pause interest while you pay down principal. A strategy used by sophisticated debt managers for decades. Mistake 8. Underinsuring or overinsuring. How to find the sweet spot. Insurance is about transferring catastrophic risk, not minor inconveniences. A landmark study from the Insurance Information Institute found 40% of homeowners are underinsured, by an average of 20%, while 25% pay for unnecessary riders. The sweet spot? Coverage equal to your home's rebuilding cost. Liability limits matching your net worth. And deductibles you can comfortably cover from emergency savings. Mistake 7. The subscription leak. How small monthly fees silently drain hundreds per year. This is the silent wealth killer of the digital age. The average American household subscribes to 12 recurring services at $15 each, totaling $2,160 annually. Like water dripping from a faucet. These charges seem insignificant until you see the annual total. Historical parallel. In the 1920s, installment payment plans for household goods created similar drip debt that trapped families. Before the Depression. Mistake 6. Keeping emergency savings in a checking account earning 0% interest with inflation at historical averages of 3%. Money in a zero-interest account loses purchasing power every year. High-yield savings accounts currently pay 4 to 5% API on a $10,000 emergency fund. That's $400 to $500 annually you're leaving on the table. This isn't new wisdom. Medieval merchants kept wealth in productive assets, not stagnant coffers. Understanding that idle money decays. Mistake 5. Not claiming all available employer benefits. 401k match. HSA. Stock plans. This is free money left unclaimed. A Vanguard study found employees who maximize 401k matches receive an instant 50 to 100% return on contributions. Health savings accounts offer triple tax advantages unmatched by any other vehicle. Employee stock purchase plans often include 15% discounts. An immediate return no market can guarantee. Mistake 4. Emotional investing. Buying high during FOMO and selling low during panic. Behavioral economists have documented this cycle for centuries. During the 1637 tulip mania, Speculators paid 10 times a craftsman's annual salary for a single bulb at the peak. The pattern repeats. 1929. 2000. 2008. Nobel laureate Daniel Kahneman's research shows investors who trade least outperform by 1.8% annually due to avoiding emotional decisions. Mistake 3. DIing complex tax situations without a professional. Missing deductions. The IRS estimates taxpayers overpay by $1 billion annually through missed deductions alone. Small business owners particularly lose out on home office deductions, vehicle expenses, and retirement contributions. Like a medieval merchant navigating complex trade laws, a good tax professional knows loopholes you don't. Mistake 2. Not having a will or basic estate documents. The ultimate cost to your family. Without a will, state intestacy laws decide your asset distribution, a process taking 6 to 18 months with 3 to 7% in court costs. Historical precedent. Dying without a will has fractured family fortunes since Roman times, when the law of the 12 tables dictated default inheritance. Mistake 1. The biggest one. Not tracking your net worth and having no clear financial goals. You cannot manage what you don't measure. J.P. Morgan tracked his net worth daily in ledgers. Modern tools make this effortless. Studies show people who track net worth monthly are 40% more likely to achieve financial goals. Clear goals transform abstract, saving more, into concrete. Save $500 monthly for down payment. By systematically identifying and fixing these common leaks, you can plug the holes in your financial boat and sail much faster toward your goals. Wealth preservation isn't about perfection. It's about consistent correction. Audit one category each week. Small fixes compound into significant wealth, just as small leaks compound into significant loss. Start today with mistake number 7. The subscription audit, and reclaim your financial momentum.